Afternoon, John Hardy here, Video FX update. We're having quite a comeback in risk today, though we're seeing somewhat of a divergence between the action in foreign exchange and the action on let's say equity markets. Here we have Eurodollar, the big sell-off on Friday, seeing quite a big retracement all the way back up to that resistance area, 137.40, 137.60, pretty much fully retracing what we saw Friday. But if we look at the S&P 500, we didn't retrace nearly as much. It gapped lower on the open, and then we've come back a little bit. Interesting for those technicians out there looking at equities as a barometer for risk appetite. We had the higher highs here coming on, for example, in a stochastic reading on lower highs and momentum. So some divergence there, one of those classic divergence signals. And often when markets turn around, you see quite a snapback rally after the initial sell-off impulse. If we go back to it was early May, late April, we see a similar kind of pattern. The first sell-off here, second sell-off, and we're seeing higher highs on lower and lower momentum. This led to the flash crash. And if you follow Joe Saluzzi and other commentators out there in the high-frequency trading space, you get the impression or the idea that this kind of volatility risk is still there, especially after a long period of these really persistent gains with no retracements. We sent a link out to an article talking about the nature of the ecosystem, market ecosystem, and how HFT keeps some of these prices at artificially high levels. But getting off subject there, if we go back to FX, Eurodollar again, going up towards the high. We wonder to some degree the rally today aggravated by end-of-month fixing, though that wasn't a huge flow generator because of the rather small moves in equities and bonds this month. Also, of course, I think stops playing a big role here as people were hot money, quick to get on board and shorting the exciting Egypt story, but not panning out. And one reason also to see it back higher besides those reasons is, of course, this being a March 2012 Euribor. It's still not rallying much, so we still have the market's crazy idea, crazy notion, or the market's interpretation of Trichet's crazy notion that the ECB is on the verge of hiking towards 2% in the coming year plus, and this is driving from a fundamental basis. Here we have the Eurodollar again with those two-year interest rate differentials at a new high for the cycle. On the CDS front, a little bit of support for the dollar, but not really. So again, as long as this continues, as long as the squeeze continues and the idea continues that interest rates are expectations head higher and higher without some kind of concomitant default risk increase, then we're going to see Eurodollar pressure to the upside. Let's see if the ECB later this week changes that. Looking elsewhere, we had that crude picture up as we started. Crude oil up $5-6 from last Thursday's lows, I think it is here, and we're seeing that in West Texas Intermediate as well. Hard to believe the market wants to get excited about buying up risk here with this kind of a move, but we could see the Saudis out there trying to flood the market with crude soon. I think they're probably getting very nervous about this, and other reasons to be nervous for them, of course, on the domestic political front, but that's another story. And of course, we're watching for contagion with this Egyptian situation outside of the Egyptian borders. Tomorrow, a big peace march taking place, or March of a Million, whatever the market's calling it. And this story, of course, bears continued tracking. I think it's very much cause for caution here. The implications are enormous with further unrest in the region and the risk of contagion. Looking elsewhere, the safe haven bid in, for example, Bunds, which I have here in the U.S. 10 years, similar kind of chart, fading a lot today, pretty much a mirror image of equities, and that put some pressure on the likes of, where we saw pressure on the likes of the yen to appreciate on Friday, a little bit of follow through, gap open, and then again, without the follow through in the bonds and / Bunds rally, I'm not seeing much support for the yen crosses lower. Big range trade here. Interesting small short-term resistance level there at the Ichimoku cloud and dollar yen. Not a whole lot to go on. Aussie dollar very relevant ahead of the RBA tonight, where no rate hike is expected. The Aussie's been weak of late. year forward expectations only at about 20 bips. I think guidance is not going to be terribly hawkish considering the floods and the need to sort of for the RBA to sit back and see how much this is going to impact the local economy. One reason, of course, Australian dollar is still very bid. We had copper prices still near the very highest levels of the range. A little bit of a divergence between actual copper prices and the likes of BHP Billiton stock, which I think is almost a better indicator. Nonetheless, this is what's keeping the Aussie at these levels, and one must also keep in mind that the Australian economy has become a one-trick pony. We've got quite a bit of Australian data out this week, and we've seen in recent months these surveys of manufacturing, which is albeit a very minor sector in the Australian economy, but still that and the services PMIs or services surveys and the construction surveys all at well below readings of 50, which means of course they're in contraction. So basically the Australian economy only expanding due to the mining sector and random other food exporting industries also providing some support. So that's the case for Australia. Again, though the Australian dollar is going to be very correlated with risk and some exposure to commodities as well. Sometimes the same creature, but not necessarily like we have in a situation like we have now with a big geopolitical element. So I think risk becomes more important, at least here in the short term, as long as it's a big factor than is commodities. Cable, an absolutely massive rally here. Very similar interest rate spread developments for the UK versus the US as we are seeing in Europe, the Eurozone interest rates versus the US. So this is what is justifying, in some people's minds, the cable rally. Though nothing really fundamentally changing in terms of the Bank of England's willingness to look through inflation, etc. Big resistance level here, obviously 160.50 or so, and we'll have to watch that in coming days. Certainly it doesn't help out the somewhat bearish view that was possible from Friday's close. Finally, last couple of charts. Dollar Canada, very interesting day. We closed right around parity on Friday, tried to follow through, got thrown back by the 55-day moving average. We had a fairly strong Canadian growth figure out for GDP in November, but this chart really suggests the continued uncertainty here, and I would suggest as well that the Canadian dollar is very much going to follow the direction of risk appetite in a reverse correlation. The reason I think in not being able to hold higher is because we're having an attempt to buy the dip and risk here across markets. Other interesting developments, sterling much stronger than euro, underlines this reversal here that failed to hold at new highs, though we need to work lower below the 200-day moving average, which I didn't have on this chart, but it's somewhere close to the 55-day at present, so that bears watching for now. And I think an interesting one on the day, dollar Swiss, and whether this little clearing of stops and rally here is reason to believe that we have something to trade off of for on a technical basis for a look higher. Certainly a pretty solid pattern reversal there, but the volatility low, and as well, I think for the dollar, as I've been saying, needs to have some risk aversion to get off the ground. And on that front of risk aversion, we're seeing quite a bit of divergence in the likes of emerging markets versus developed markets, certainly in currencies, and in some cases the bond spreads. Look at the Turkish lira, close to a low in a longer time frame versus this could hardly be right on the x-axis. Let me update that. That was weekly for dollar Turkish lira, and we're having a technical problem here, not related to the charts, but probably related to our recording software. But basically, currencies like the South African rand and Turkish lira are not doing well at all in this environment. So some divergence there. Let's see which way this breaks. Let's keep an eye on Egypt, and be very aware that this is a very busy week data-wise. Tomorrow we have the U.S. ISM after an incredibly strong Chicago PMI with new orders going to I think it was an all-time high since 1983 on new orders there. Quite impressive. And then even more important for the broader U.S. economy, the ISM non-manufacturing on Thursday. ECB also out Thursday, so let's see if this euro strength pivots or accelerates off of what Mr. Trichet has to say, if he is about to hike to the moon as the market seems to expect. And of course Friday with the non-farm payroll report, which we'll be watching closely, and even previous to that, Thursdays, of course, weekly jobless claims, which should provide leading indications on the U.S. job market ahead of the non-farm payroll, but that's more on a longer-term basis. Of course, the last couple of readings, so certainly the last jobless claim reading, very disappointing for those looking for a recovery in the U.S. job market. Well, that's my more than 10 minutes, so I've reached my quota here. In the meantime, until tomorrow, be very careful out there. Keep your eyes to the ground, keep your nose to the ground, and we'll see you tomorrow. Over and out.